You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
The trading day doesn't start when the opening bell rings. Pros understand that risk never sleeps, and market-moving events happen around the clock. How can you arm yourself with the information you need to understand what's going on across the pond and how it can impact your portfolio? Welcome to the European Market Brief, your go-to source for information on the fast-moving European derivatives markets. Each episode brings you expert insights into the latest market trends, discussions of cutting-edge trading strategies, breakdowns of exciting new products, and analysis of thought-provoking trading activity. The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of VSTOXX, VSTOXX, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com. So join us as we shine a spotlight across the pond and explore the cross-border volatility, regulation, and innovation that makes the marketplace so fascinating. It's time to get the European Market Brief.
All right, everybody. That music means we are back once again. It is time for episode 7. Yes, hard to believe. We're already on number 7. Time flies when you're talking all things European derivatives. Welcome to the European Market Brief. I would say the newest addition to the network, but we've added one show since this. So the network continues to grow, continues to explode. Thanks to all of you out there who've been checking out all the recent editions of Futures Rundown, of course, kicking it off. Then, of course, the European Market Brief, and now the Hot Options Report. So no shortage of content coming at you here on the network. And of course, if you're ready for it, if you want to go above and beyond, you want to win fabulous prizes like our pro member, Mr. Unlimited, did just yesterday, winning the July Pro Trading Crate. Only one place to go. Options Oddities coming at you there as well. Live streams, pro Q&As, early exclusives, all sorts of fun. The optionsinsider.com/pro is the place to go to learn all about it. As we learn all about who's joining us on episode 7 of the European Market Brief, let's kick things off. Going out to my cohort in all things European derivatives crime, none other than Mr. Russell Rhoads, holding court over there at Indiana University, where he is busy corrupting the young minds of the future. Mr. Rhoads, welcome back to the European Market Brief, sir.
I'm hoping to corrupt some professionals today as well.
Ooh, let's
you always say I'm correcting young minds. I'm going for the old minds as well.
Let's corrupt them all equally. And I'm trying to think, I don't think we've ever had you two on a show together before, so this is kind of fun. You two are usually bitter enemies, diametrically opposed, schools battling, educational entities battling, but we brought you together today in the spirit of détente and peace as we are joined once again by our good buddy, Mr. Rich Excel, who, when he's not talking to us, is busy running what I've only half jokingly referred to as the Hogwarts for derivatives traders over there at the University of Illinois. Rich, welcome back to the show, and I apologize for putting you on a program with your lifelong nemesis, Mr. Rhoads, sir.
Yeah, I think we've been on before, Russell. I think we have.
I think we did Volvius once, but the thing that Mark's missing with respect to the rivalry is the Little League World Series.
Oh, yeah.
Yeah, Hinsdale and Clarendon Hills, which were next door to each other. Let's just say Hinsdale's not representing Illinois this year or the Great Lakes. Clarendon Hills is.
Oh,
That's
So,
so true.
yeah, and that's
You know,
much more serious than Indiana, Illinois to us.
the
I
rivalry
totally
runs
agree.
deep. It runs deep.
I think
over
there's some
there.
controversy around even Clarendon Hills representing anybody, but that's okay. It's all
Hey,
right.
now.
I'm glad to be back. And yes, I definitely run Hogwarts at U of I. My gray beard is not quite as long as Dumbledore's, but I'm trying to get there.
You're working on it. You're working on it. All right. And holding down the Eurex hot seat on the program this week, yet another newcomer to the program and indeed to the network. He is Sascha Semroch from the product and business development team over there at Eurex. Sascha, welcome to the European Market Brief, sir.
Thank you very much, Mark, and thank you very much for having me. Yeah, I'm product developer for the last 18 years, focusing on equity derivatives, volatility derivatives, crypto, and most recently credit. And I'm really happy and looking forward to discuss with you guys the latest developments in our futures market here.
All right. Sounds like we got the right guy. All right. With the team assembled, let's kick things off with a Continental conversation.
It's time to catch up with the thought leaders who are shaping the European derivatives markets. It's time to have Continental Conversations.
All right, everybody, welcome to the Continental Conversations, a portion of the show where we take a little bit of a deeper dive into a particular topic or product area. Today, we're going to kind of do a combo out there as we're going to dive into the world of futures. Yes, they do trade those futures things over there across the pond, and they're kind of interesting. So let's dive into them. I know for some of the listeners of this show, you might be hearing this saying, oh my God, futures. What are we talking about? What are we getting into? So let's just set the table with some basics of futures just to get that out of the way. If you're familiar with stocks, you know you can go out and buy, let's say, shares of Apple stock, and you can set it and forget it, put it in your account, and it could last forever until Apple goes away. Not the case with the future. You know, it's a contract at the end of the day, and it has, very importantly, an expiration date out there. So that's what's challenging for a lot of people out there when you're coming to grips with any derivatives contract, futures or indeed options. You have to be right within a certain window. If you're right one day after your window expires, doesn't really matter. Trust me, all options traders have been there. We've all been right a little bit too late. So it's definitely an interesting challenge. Of course, when we're talking about options a lot on the network, we're talking all about the Greeks, your delta, gammas, thetas, vegas, all that fun. Throw most of that away when we're talking about futures. They are delta 1 assets after all. So we're talking all delta. We're talking all direction at the end of the day. That's pretty much what our focus is. So don't worry about your thetas and your vegas and all that other fun stuff. And then we get into some other interesting nuances, which I'm sure Sascha will have some thoughts on, because I know when we kicked off our futures rundown program, there were a lot of people out there who were very nervous. They were very worried, like, futures? Wait a minute, you mean I'm going to have a truckload of crude oil dumped on my lawn at 2 a.m.? I'm not going to trade those things. They're terrifying. So let's get into that, Sascha. The notion of cash settled versus physically settled, physically delivered futures. What do we mean by those terms? And then what do you folks over there at Eurex, what do you focus on primarily? And is there an opportunity for me at Eurex to get a truckload of something fun delivered to my lawn at 2 a.m.?
I think that's the most relevant question on when you discuss cash settled versus physically delivered. So you need, for cash settled futures, you need to have a mark in your calendar. When is expiry? Because most of the time you just don't want to have that delivery. I'm thinking of your pork belly futures there. If you forget to unwind your position before expiry, then you will have loads of barbecues coming up. And this is something that you want to avoid. So most of our futures are cash settled, index futures anyways. I mean, delivering a basket of stocks is something that is, let's say, from an operational perspective, a little bit cumbersome. We have physical delivery as much as you do in our fixed income futures. So we have Bund, Bobble, Schatz futures, and the intro mentioned all of them, various maturities and various tenors, but all of them settle into a, let's say, pool of bonds where you can choose the one that's the cheapest at the day of settlement, and then you can deliver the either 2 years, 5 years, or 10 years bond into the settlement mechanism, and then you're out.
So I can get a virtual truckload of the bund delivered to my house at 2 a.m. That's not quite as terrifying, I think, for a lot of people as the proverbial pork bellies. Pork bellies, take your pick. Crude oil, whatever it is you don't want dumped on your lawn at 2 a.m. out there. Rich, let's get to some of the nuances. I know when you're talking to your students over there at the University of Illinois, you walk through some of the basics of all things futures. Let's get into that now. I know one of the nuances that really throws people off when you're talking futures, we've seen this with our futures rundown program very recently. Stocks, you're talking about a tick. Apple moves a tick, it's a penny. It's pretty straightforward. Tick prices, that is of course, the amount that a futures will move. They move tick by tick, listeners. It varies depending on the product. And so things get a little bit wild. Let's talk about that, Rich. The notion of futures pricing and what do we mean by ticks?
Yeah, for sure. I mean, maybe can I just add something on the cash versus physical? I think maybe
we are done with that. I'm just
okay.
Go ahead.
Moving on.
I'm just kidding.
I just think one thing to me that I always think is easy to when I'm talking to students for them to remember is like, when you're kind of trying to how to bucket it is who are the end users, because the futures are ultimately created for end users initially, right? We're going to have market makers and speculators step in and provide a lot of liquidity along the ways, but ultimately it's end users. And do the end users want to take delivery or not? Like if it's a commodity, if farmers and grain elevator operators, they want to take or make delivery at some point. That's what they're looking to do. They don't mind doing that. When you talk about the financial products, especially the equities types of products or volatility type of products, or even now crypto, taking delivery is not really what the end users were looking to use those futures for. So that's kind of how I like to think of it. And you're right. Like if you're not looking to take delivery, then you want to be really, really careful about making sure you're rolling those futures out. As we saw with ultimately probably the most egregious example was in the oil markets back, when the front, it wasn't the active contract, but it was the front month. Well, oil prices went negative, right? So tick size, I mean, that's it's easy when we think about stocks, et cetera, trading pennies. Typically these days now, even maybe fractions of a penny in some of them. But tick size, you have to, when you're getting involved in the product, you have to understand what is the tick size, what's the multiplier on each of the products. It is going to vary. It's going to typically, you're trying to get to some sort of notional size ultimately, when it's at its core. But I think that's the one thing that you have to really look at, and that's the first thing to dig into is every time you see a price change, what's the increment in which it changes, and what's the dollar value of that increment, right? We think in futures markets, we think in terms of ticks, but it's not $1 or €1 every time it ticks. It might be, for instance, in the VSTOXX, it's probably going to be €5 every time it ticks. And so we want to be thinking about what is the dollar amount of every time we see that incremental price change. And it is going to be different depending on the products that you're trading. And so that's the onus is on the traders to think about, okay, and that's, what is that dollar amount? And that is going to adjust your position, how you think about it, of, how you want to, what's the dollar amount of the position that you want to see change on every given second.
Let's keep the futures 101 party rolling. There's a lot of other elements to trading futures out there. Of course, the size of the contract, that also intimidates people because, you're not talking about just one lot or 100 lot of shares. You're talking about a contract size that varies depending on what you're getting. Are you getting 1,000 bushels of corn? Are you getting, a couple hundred barrels of something? It all depends on the contract that you're trading. And then, of course, as a result, the notional value of that contract is going to vary depending on the product. And just to add a little bit of extra fun to the futures world, like I mentioned earlier, if you buy Apple stock, everyone's bought a stock in their life, and it's gone against them. And they say, you know what? That's just a long-term hold right now. It's a long-term buy and hold. I'm going to put it in my account until it comes back to the level I want it. That is impossible in the world of futures. Futures don't let you do that. Futures are marked to market at the end of every trading session. So you really can't just set it and forget it. your gains, your losses, they're hitting you in the face every day. Your accounts are debited or credited at the end of every trading session. So that is a little bit intimidating for new traders to come to grips with as well. Mr. Rhoads, what are your thoughts on the notional value of these contracts, and as well as the notion that you can't just set it and forget it? You can't just buy and hold these products, sir.
Yeah, you can't just buy and hold these products, but and you've talked about size and knowing the tick size. You also in the option world, if I'm and I know this is very basic and people can poke all kind of holes in this one, but if I'm worried about the equity markets between now and December. In the option market, I may take a look at buying some December puts. If I'm worried about the equity markets right now, between now and December, I probably, want to take a look at the VSTOXX 50 futures that expire in September with the plan on, rolling those futures and having that exposure in the December contract, mainly for liquidity purposes. And you start to see things roll as we get close to one of those quarterly expirations for a lot of futures contracts, and of course in the volatility space, you always, if you want some sort of exposure to, and I know we're going to talk about VSTOXX some a little bit later, but if you want exposure to volatility, the best tends to be the front month futures contract. And if you think we're going to get a spike in volatility between now and December, you probably want to be at this point in the September contract, but in about 4 weeks you would roll out to October, et cetera. So, the futures markets do have their own slightly, unique characteristics that if you're nothing but an option trader, you need to learn about. Also, not a huge issue, but you typically futures contracts, and I'm not including the volatility-oriented ones, but typically futures contracts will trade within a fair value, but that fair value relationship will narrow over time, and it could have a small impact on your trading as well. So, but that's something that you do need to be aware of with futures relative to options. And I'm using an option standpoint because because it says options on your shirt right now, Mark Longo.
Yes.
I just
that is the frame of reference. That is the frame of reference for most of our listeners coming to grips with all this fun stuff. But you know what? The fun doesn't stop there, listeners. There's a lot more fun when it comes to futures. Dividends and interest rates, these things still exist in the futures market, and they come together in a term you may have heard of, maybe you're not that familiar with, called the basis. Sascha, why don't you walk us through the basis? What are we talking about? How do dividends and interest rates impact this? And how does this basis evolve over the life of the contracts?
Well, the basis is essentially the difference between the futures price and the current index level stock price, or whatever you want to look at. And it's mainly driven off the cost of carry. And this is what makes futures prices easy to understand, because if you buy the futures, you don't need to spend all the money to buy the underlying asset like the index or the stock or whatever you are looking at, but somebody else will. And this somebody else that sells you the futures will buy the asset and will fund the purchase of the asset as of today. So between now and then, now and expiry, your counterpart will run the cost of carry, the financing, the funding, and everything. And then at the same time, you will also receive dividends during the lifetime of the contract, but you won't. If you look at an expiry past the dividend date, the dividend will long be paid when the future settles. So it won't be part of the futures price. So the dividends and the risk-free rate or the cost of funding are the two elements that form the basis normally for an index future.
You mentioned expiration and expiry. Let's just get there now as well. Sascha, you're our product guy, so I'll stay with you on this one, because obviously expiration, a key factor for any derivative contract, including the futures markets and futures product out there. But of course, doesn't mean you have to hold things into expiration at the end of the day. You can obviously close them out. You can also, of course, roll them into another month. So there's a lot going on as we head into that expiration time frame? Why don't you walk us through it, Sascha?
Well, I mean, the expiration week is normally the most exciting week in a month because, as you said, most of the futures contracts are rolled during that period. So 1 week before expiry, the roll normally starts, and it doesn't change if you look at our VSTOXX DAX futures or our fixed income futures and Bund Bobble Schatz. They are mostly being rolled, and this is done mainly via our calendar spread. So you can either buy the next month's future, sell the front month's future, and then you have rolled your position into the next expiry cycle, or you simply use the calendar spread functionality, which allows you to buy and sell the two expiries in one go. And the nice feature about this calendar spread functionality is normally much tighter than if you cross two bid offer spreads. So buying one future, selling the other future, you have to cross two spreads. If you do that on a calendar spread, you do this in one go. And normally the calendar spread, bid offer spread, is much tighter than the bid offer spread in the outright. So you save twice, you get a better price, and you don't cross the spread twice. And this is what happens in a roll month. So every 3 months, when our futures expire, they are being rolled to allow people to continue their exposure going further forward.
All right, Mr. Rich, sir, when people are coming to grips with futures here in the U.S. for the first time, one of the things that they're immediately assaulted with on the landing page of whatever broker or exchange they're going to is this just incredible plethora of margin rates. It can be a little overwhelming to the newcomers who are just coming to futures for the first time. Again, to compare it to stocks, a much simpler example. Usually you buy stock, you buy it 1-to-1. Maybe if you buy it on margin, you're talking 50%. That's a pretty straightforward bit of math for most people to come to grips with. But futures, a very different beast entirely. You have initial margin, you have maintenance margin, you have overnight margin. All these things are being debited and credited on a mark-to-market basis, and you have different firms offering different rates in addition to what the base rate that the exchange is setting. So there's a lot of moving parts when it comes to margin, Mr. Rich. So when you're trying to tackle this subject and make it palatable to the new students over there at the Hogwarts for derivatives traders, how do you come to grips with it, sir?
Well, you're right that there's a lot of different moving parts, a lot of different jargon. Every industry has got its jargon, right? And the futures industry, no different. I think you can look at that as risk and confusion, or you can look at that as opportunity, because one of the reasons that margining is so important is really ultimately trying to from a clearance standpoint, make sure that we can maintain the integrity of the trades and of the clearing across the exchange. But it also, the idea of initial margin and maintenance margin, as you said, the money you have to put up when you initially do the trade, and then the mark to market that you see every day, that variation or maintenance margin, which is how much your account went up or down and how much you have to top up your account or be able to take off the account. That's ultimately provides and enables this to be a very cash efficient product. And I think that is where futures really can be beneficial to cash. And that's why I think you see certainly for a lot of institutions, they really appreciate the futures market because of that cash efficiency. And I think to the extent that retail can tap into that, they can actually be a little bit more cash efficient themselves. And I mean, the other thing that I would say that for institutions is ultimately you get into cross-product margining or even portfolio margining, which means that you're not just looking at the initial and maintenance margin on the single product, but then the exchange is looking at it across the entire portfolio of products that you have and says, okay, what is the risk of this person blowing up, taking into account correlations of assets and things of that nature, using risk-based models, things of all those things, which ultimately lowers your margins even more and makes you even more capital efficient. And so I think, that's certainly at the most, at the institutions that are more aggressive and do the most volume will benefit from that. But I think retail accounts can certainly kind of tap into that. And I think a way where you might even see that from a very basic standpoint is kind of what Sascha was talking about with basis or with the rolls, right, around expiration. And there are some people in the futures markets who don't even trade directionally. They simply trade they just trade those calendar spreads that roll, and they're not necessarily taking a directional view on the underlying, because if you look at the roll, the roll price is really just comes down to the near term basis minus the far term basis, because the spot component cancels out, and so they're really just trading the change in basis in each contract, which comes down to really the change in the net financing costs in each. So it really becomes, you could trade you could trade future spreads in any product and really be making an interest rate bet, and looking at it, it's a much lower volatility, and then therefore it's going to have much better margin for you as well. So I think that's some of the nuances of the futures market that we can look at it and say, well, I don't really understand. It's not like my stock portfolio, et cetera, but it actually can be much more capital efficient and much more interesting, and provide actually more opportunity than it does provide any more risk.
Yeah, when you're talking about capital efficiency, at the end of the day, it's kind of hard to beat futures. I mean, I mentioned, of course, looking at your traditional stock, the best you're going to do on a capital efficiency there is going to be 50% on the margin front. Now, you compare that to futures, obviously it varies by product, but it's going to range somewhere in the ballpark of really aggressive 3% to somewhere around 10 to 12%. So again, substantially better than what you're going to get in the straight stock world. Mr. Rhoads, any thoughts on the ever-evolving world of futures margin and some of the nuances and differences people can expect come into grips with this for the first time? And if you have anything you want to add on the nuances of, let's take a layer on top of it, let's go a derivative on top of a derivative, let's go options on futures, or anything you want to add there?
I think Rich hit on it pretty well. I feel like when you're utilizing options on futures, the mentality could practically be just like the cash option market, just because of the low notional on the options that actually trade on the futures. One of the nice things about the VSTOXX space is those are options on futures, I believe, and which allows us in the U.S. to take advantage of the pricing differences between VSTOXX and VIX. Also, one of the great things about the volatility space and the futures on the volatility space is they behave so differently than any other futures markets out there. And in the academic space, we often talk about diversification across different types of asset classes. I think one of the great diversification benefits behind being able to use VSTOXX futures is the pricing of VSTOXX futures relative to the spot index, and how you don't have that arbitrage relationship. So at times you can see the futures maybe a bit overpriced relative to where you think the index is going, or underpriced relative to where the index is going. And that means that the volatility derivatives offer a really nice complement, or a great alternative to hedge your equity portfolio by using derivatives that are based on the volatility of that equity market. Then also, one of the fun things with respect to volatility futures is just comparing VIX versus VSTOXX. Right now, VSTOXX is just under 17, and the August future is about 15 cents higher. VIX is around 15, and their August future is about 16.20. It's about 2.20 higher, or $1.20 higher. But then when you go out to the following month, both futures are in line with each other. There's lots of opportunities to look at the expectations around volatility versus each other in the U.S. and in Europe. And it's not just, we often focus on the difference between VIX and VSTOXX. I actually like to focus on the difference between the front month futures in each market. I think that's a better indication of what people are actually thinking. So all kinds of information out of those. Yep.
Russell, I'd love to ask you a question, because I know that historically a lot of people, particularly in Europe, would trade VSTOXX versus VIX as a spread, and look at when it gets a little bit extreme, et cetera, like you're kind of talking about. But it's interesting to me, because now when you look at potentially changing trade policy and potentially economies that are getting maybe less correlated, that VSTOXX has to maybe become its own standalone product, because of liquidity standpoint 10 years ago, even everyone in Europe was using VIX because it was just much more liquid. But now VSTOXX is very liquid, and on top of it, you might be seeing economies decoupled, where there's more opportunities to even kind of trade that difference. I don't know what your thoughts are on that.
I do feel like there's become more of a disconnect over the past 2 or 3 years between, that they weren't just tracking each other as closely as they have in the past. And also, I think a lot of traders have discovered that VSTOXX behaves very differently than VIX, especially when we get those volatility events. You do get more bang for your buck by using VSTOXX as opposed to VIX when we get those volatility events. It's just it's the nature of that contract. Also, I've got some systematic approaches to trading VIX that also work with VSTOXX, but you have to put in different parameters. I like to be short volatility into expiration. For VSTOXX, you usually want to put on a trade about a week in advance. For VIX, it's only a couple of days in advance. The timing is different on those two. And then finally, there's a ratio spread that I think makes a lot of sense as a hedge against a volatility event, that if we don't get the volatility event, you may even get a little bit of a credit. It's something that I found systematically works in the VSTOXX space that just doesn't work in VIX. VSTOXX, you mentioned it being like its standalone market. I think as people pay attention to VSTOXX and they look at how it behaves when we have European-centric volatility events, or we've got a global event that maybe hits the U.S. a bit more than it might hit Europe. Maybe it's something between China and the U.S. and Europe gets to sit on the sidelines and laugh at us. That can have a different impact on VSTOXX as well. So I do think that I've seen what you're talking about in the numbers for sure.
Well, Sascha, you're the product guy. VSTOXX is your baby. Anything you want to add here on some of the subtle nuances of the pricing in VSTOXX, perhaps versus the traditional futures market, sir?
Well, I think this is the one of the most remarkable particularities here, and that is something that VSTOXX and VIX both have in common. You don't have a real cost of carry where you price the basis on when you look at VSTOXX futures or VIX futures. VSTOXX and VIX are both expected values of where volatility is at expiry. So it's a really expectation device or expectation vehicle. And what you do to price the VSTOXX futures, you kind of estimate where, based on the term structure in the underlying options, like for VSTOXX, it's the EuroSTOXX 50 options. For VIX, it's the S&P 500 options. The term structure of the options tells you where the future should be. Whereas in traditional futures, you look at the spot and how much it costs me to finance the spot all the way until expiry. And the volatility index futures, they look at where do we think volatility will be on expiry given the current term structure of the options. And that makes the pricing very difficult and very tricky. But it's certainly something to mention. And then to Russell's point, where the differences are between VIX and VSTOXX, what you can always see is the difference in the term structure, especially in the front 2 months, where VIX tends to be steeper than VSTOXX. And Russell, I think he just gave us the numbers, how big the difference is these days. And much of this comes from the fact that there is an exchange-traded note that tracks the VIX, and we don't have that same exchange-traded notes that tracks the VSTOXX. And the exchange-traded notes needs to roll every day, so it sells front months and it buys back months. And that gives the pressure on the term structure, which makes it steeper. So the roll down in VIX futures is always faster and quicker, or not always, but many times faster and quicker than it is in the VSTOXX. And this is something that we have seen people actually playing in a relative value by buying VSTOXX, selling VIX, and expecting that VIX will deteriorate faster in its price towards expiry than VSTOXX does.
All right, I do believe we'll be coming back to VSTOXX in a little bit when we answer the red phone. But before we get there, let's wrap up our conversation. Some of the pros and cons, let's say futures versus a traditional asset class you may be more familiar with, like stocks. We kind of just laid out a lot of the pros and some of the cons. One of the big pros with futures is that you can trade a lot more than just stocks. Obviously, with stocks, you're kind of limited to stocks. That's kind of the name of the game. Futures, you can trade whatever your heart's desire. We just talked about trading volatility. You could trade ags, metals, crypto, whatever floats your boat. There is probably a futures product out there that you could trade. So that in and of itself is a huge, huge benefit. Also, you can go beyond your traditional market hours. So if the opening and closing bell is a little bit grating to you, then the futures markets may be the salvation for you on that front. They trade a much wider array of hours out there. We already talked about the capital efficiency. The best you're going to do with stocks is 50%. With futures, you're talking, again, a wide range. 3% on the low end. That's very low, though, all the way up to about 12 to 15% on the high end. Either way, much better than you're talking about just going straight margin. For stocks, we didn't even get into this on the show, but futures, you may be intimidated by the size. You might think, oh, well, 1,000 barrels of crude oil or 1,000 bushels or whatever, that's too much for me. The exchanges have heard you. They have micros, they have bite-sized contracts now. So if you're intimidated by the size of some of these legacy contracts, there are going to be micros and minis out there. So there's going to be a size for every budget out there. We already talked about delivery as well. It's kind of the bugbear that looms over this whole space, the notion that you're going to get this truckload of crude oil or lithium on your lawn in the middle of the night. But we already said most of these products we're talking about, certainly most of the Eurex ones, are cash settled. Most of the big ones you're going to trade here are cash settled as well. And also, if you're a domestic U.S. customer, your broker is not going to let you take delivery. They're probably going to close it out or contact you ahead of that. So I wouldn't really worry about forgetting to close out your particular contract and all of a sudden the mythical truck appears on your lawn at 2 a.m. Now, there are some pros to stocks as well. The big one, of course, is they don't expire. So if you're not right within your window, you could just wait longer with a stock. So that is a nice thing out there. They're not marked to market either, so you don't have to realize your gains and losses every day. Stocks do capture dividends out there, so that is a benefit for you. You also, if you buy a stock in a company, you can get some say in that company. You get some voting rights, so that is a nice thing out there. The world of futures symbology, we've gone into this on our Futures Rundown show. Futures symbology, I think to call it nonsensical is charitable. It is a rough thing, especially for newcomers coming to grips with the month codes, the contract codes, how all that works. It literally makes no sense. So again, check out some of our early episodes of the Futures Rundown if you want deep dives into that. And then, of course, with the stock, if you are worried about that 0.001% chance of the proverbial truck coming to your lawn at 2 a.m., you don't have to worry about that at all with stocks. You know, let's go around the horn one last time before we answer the red phone. Everyone can give their final thoughts on futures, maybe some pros and cons, or maybe some lessons you've learned that you want to leave with the listeners when it comes to coming to grips with futures. Rich, we'll start with you because, again, when you're not chatting with us, you're dealing with this stuff day to day with all the kids over there at Hogwarts, sir.
Yeah, I guess one thing that we didn't really touch on, you probably have touched on it before, but just to understand if you're really delving into the futures in the first place, is understand what the futures curve is, what the normal futures curve looks like. I mean, Sascha and Russell both talked about what it looks like in the VIX versus VSTOXX, et cetera. But, is the product that you're trading typically in contango where futures, where it's up upward sloping curve or backwardation? And so what's the current curve versus what's the normal curve and what it should be? Because it isn't always going to be the same, right? We'll see the term structure, much like you would see in volatility, but the term structure moving up and down depending on what's going on in the world. So just know where you are, know your entry levels, et cetera. Don't get caught off guard by that. But otherwise, I mean, I think don't get caught up on the jargon. There's a lot of capital efficiency here, a lot of flexibility to trade a lot of asset classes around the world. So I think I would encourage people to look at it as an opportunity, not as a risk.
Mr. Rhoads, same question for you. Any other last thoughts, nuances of futures trading you want to leave people with, or maybe some developments you've noticed that they should keep an eye on? Either way, sir, the floor is yours.
Not necessarily developments, but I think Oh, well, I know, and Rich is probably aware of this as well. Most undergrads, when they show up at college, their knowledge about the markets really is just individual stocks. Most college students have very little capital to get started. They may, I know the futures market's very risky, but there are smaller contracts that allow you to, trade as frequently as you would like to without a certain amount of capital, which is a rule that you need in the United States. If you don't have, I believe it's $25,000, you can't day trade stocks out to your heart's content. You can do so within the futures markets. And then, just something that I always like to, just throw out there. If you're a macro manager, you could manage your whole hedge fund just using futures that are listed at Eurex. If you were a European macro manager, you could manage your whole portfolio just using futures at that one exchange.
And one thing I would add to what Russell said, and I would agree with him, that on the spectrum of stock to zero DTE options, futures act a lot more like stocks than zero DTE. Yeah, there's some nuances you have to worry about, but they're not nearly as extreme as where we've kind of gotten in some other derivative products.
All right, Sascha, and the last word is yours on all things futures versus, let's say, stocks, as well as any other nuances or things you want to leave the listeners with on this subject, sir.
I would just like to pick on the point that Rich was making on the term structure of the futures. Is it backwardation? Is it contango? I mean, one thing, and people look at futures prices versus the cash index for argument's sake, and they wonder, why is the 1 year future so much lower than the current stock level? And this is something that you shouldn't be confused by. It's simply the fact that the dividend payments are much higher than the interest rates that you need to pay to fund that position, and that drives drives the futures prices into the negative. And this is something, I mean, you just need to understand what is creating that difference between futures and cash. And in, I would say, most of the cases, it is the fact that you have the two elements of the basis, which is the dividends and the cost of carry, is moving these two apart, unless you have an event that also I think Rich referred to, when the oil futures went negative because people couldn't take delivery. I remember it was the storage in where the WTI future settled that was full, and that people were just terrified of having to take delivery in a full storage. Wasn't that the case?
That was the case, yes. Yeah. The storage was effectively full. No room in Cushing for WTI. And
this can't happen with cash-settled futures because you don't have to take consideration of these kind of things.
Yeah.
So cash-settled futures are safer than physically delivered. You may want to say.
There is a push for more cash settlement here in the U.S. There was talk about, when everyone's trying to get these zero DTE options listed here in the equities, there was talk of creating an entirely cash-settled suite of single-name equity options. Doesn't seem like that's happening, but that was the talk for a while out there. But yes, the whole WTI debacle really reminded everyone that the devil is in the details when it comes to the logistical side of futures delivery at the end of the day. But you know what, listeners? The devil's never in your feedback. So let's get to some of that right now as we answer the red phone.
What's on your mind as you're navigating the wild world of European derivatives? Let's find out as we answer the red phone.
All right, everybody. Welcome to the red phone, the portion of the show where we answer some of your listener questions. We appreciate all of you out there who are engaging with the show. To me, this is still the brand new show on the network, even though we've added a new show since then. But to me, it's always fun to see people engaging and listening. So thanks to everyone who takes the time to do that. We always endeavor to save a little bit of time at the end of the show just for you folks out there. Let's kick it off here. Rich, we can't have you on without talking a little bit of FX. Looks like we have a question right up your alley from a listener, goes by NL Bast, maybe Baste. They write in to say, hello. I have a question for the European Market Brief program. Well, you passed the first test, NL Bast. You sent it to the right show. He says, I would like to request an episode about the FX market in Europe. and how native currencies like the pound, euro, etc. are faring versus the dollar. If the dollar continues to weaken, where should I be focusing my currency trading? Thank you so much. Well, Rich, you cut your teeth in the FX pit. It's been a hot year for FX trading. You know, I like to joke on some of our other programs that you've been on with me, like This Week in Futures Options, that FX doesn't really come up ever because the entire complex is a sub 7 vol and nothing really seems to happen. But the better part of the last year, we've seen, of course, this trade war talk, tariffs, a very usually arcane economic concept, are suddenly top of mind for everyone. And it makes the FX market, let's say, a little bit more exciting. Maybe we will do a full episode on all things FX down the road. So that's something to keep in mind. Good suggestion, NL Bass. But before we get there, Rich, you're on with us now. You're always watching all things FX. So what do you have to say for NL Bass about how native currencies in Europe, like the pound and the euro, are currently faring versus the US dollar? And he also notes correctly that the dollar has been weakening now for the last few months. He says if that continues, where should I be focusing my currency trading? So a two-parter, Mr. Rich. Have at it.
Yeah, for sure. And NL Bass is all over it for sure. I a full episode on FX that might be pushing a little bit, as much as I would be excited about that. But as you said, it's still sub 7.
I think you would be the audience for that show, Rich. You and NL Bass.
Exactly. Yeah, a year ago, we're talking about sterling, the pound, and as well as the euro going to parity with the dollar, right? That there was no interest, and there was all the problems that were hitting Europe and the UK versus the US, and people were saying these currencies are broken, et cetera. Fast forward a year, and now all of a sudden, because of all the air quotes self-inflicted wounds in the United States, where now people want to trash the dollar, and we're seeing money flow back into the UK and back into Europe. And so, yes, historically, when we've seen the dollar weaken, we've seen assets outside the US, typically European stocks or Asian stocks, et cetera, outperform relative to the US. That's been the case because usually the U.S., because of the index composition, is seen as actually decidedly less cyclical than other markets. And so usually when the dollar is weakening and other markets are doing well, it's when a time when we have a lot of global growth and people want to invest outside the U.S. We're not really seeing that so much this year because global growth is still kind of trudging along, and it's really being driven by something completely different. And and even in the U.S., it's the AI boom, which is driving a handful of stocks, and you're seeing the vast majority of other stocks, including small and mid cap stocks, get left behind. So, the four most dangerous words in finance are it's different this time, but it does feel it's a little bit different this time. And so I think from an FX standpoint, it potentially creates some opportunity, because if you look at what's been this nervousness that's been driving the dollar lower, if we look at typical drivers of foreign exchange, which is investment flows and or interest rate differentials, they would be suggesting that we've seen an overreaction in the dollar, actually. And so I think from a trading standpoint within FX, there's potentially some opportunities for NL Bass and others to take a look at, because there has definitely been a speculative flow out of the dollar into these other currencies that is not necessarily being met by the fundamentals that we're seeing in the asset flows in those relative economies, in global growth, et cetera.
All right, we'll keep rolling on to this next question here. This is right up your alley, Mr. Russell, and probably Sascha as well. Let's go to CMT. Maybe he's a chartered market technician, or maybe he dislikes country music television. Either way, he says, how is VSTOXX comparing to VIX right now in the current climate? This is a seasonally weak time for vol anyway. Are there any catalysts for vol on the near term in the EU that could potentially cause a disruption versus VIX? Also, do the traditional setups of ratio spreads and verticals apply? Well, CMT, I definitely encourage you, if you are a new listener to the show, go back a few episodes. We did do a full deep dive into all things VSTOXX, how it shapes up versus VIX, and how some of the traditional strategies you may be familiar with in the vol space, how they apply or potentially don't apply as well in all things VSTOXX. So I encourage you and anyone else listening who's intrigued by this to go check out that episode. This is only 7 episodes, so it's not that many to go back in on the archive and check it out. But that said, we can give him an updated look right now, Mr. Rhoads. You kind of touched on it a little bit earlier in the show, but anything else you're seeing right now, VIX versus VSTOXX? Are there any interesting catalysts you're keeping an eye on in the EU area right now? I mean, obviously, we have Putin meeting with Trump this week, so that could potentially be a catalyst for Europe. But see anything else on the horizon may cause a disruption with VIX versus VSTOXX? And lastly, he wants to know about some of his favorite vol trades, ratio spreads. I'm assuming he means, selling 1, buying 2, buying 3 to the upside. And the traditional vertical, how do they work in VSTOXX, sir?
First off, on the catalyst thing, I believe we have pretty much gotten past any of the real near-term catalysts, and that's showing up in VSTOXX volume, which I think the September future may have traded just a few more contracts than the August future today, or at least last I checked on the volume. So even though we've got a little over a week until expiration, so it does look like people are looking out beyond this week into the balance of August and into September. I always feel like inflation numbers may be the thing that really gets us going. We had an inflation number in the U.S. as I sit here today, and it really it was kind of a nothing burger. So I'm not really sure what catalysts, if there's any known unknowns hanging over the European market that might have a different impact on Europe than the U.S. right now. I know periodically we'll have an election or something along those lines, but I don't think there's any real reason for the difference between VSTOXX and VIX right now at almost a couple of points. And like I said, the September futures are pretty much in line with each other, which I guess we could take that at a very high level as the expectations are equally risky for both areas of the financial markets going into September.
All right, Sascha, the last word is yours, sir. Anything you want to add here for our listener CMT on thoughts, VIX versus VSTOXX? Obviously, you're hanging out in the Eurozone, so any potential catalysts on the horizon that you're keeping an eye on from a European vol perspective? And if you have any thoughts as well on the last part of his question about how traditional setups apply in VSTOXX, have at it, sir.
Well, I mean, first of all, I would say Russell said it all, that the term structures in VIX and VSTOXX are pretty much in line, except for this nuance in the front 2 months that behave a little bit differently. But other than that, so there are not many known unknowns on the horizon. The war in the Ukraine, there is certainly the most topical. Nobody knows when it ends, and I think this is that could be the one thing that can have a let's say an ad hoc impact on the VSTOXX, depending on which way that conversation goes. If that has a surprising outcome, then you can probably expect a volt spike in the VSTOXX, where the VIX may stay a little bit more calm. For all the known unknowns that are already in the macro schedule, we always see the 2-by-1 call spread in VSTOXX options financed by the put. And Russell mentioned that also early on, that is one of the most popular ratio trades that can be even, let's say, premium neutral. If you choose the right strikes, then you can construct a position that costs you next to nothing. And if the event goes by and doesn't create any hiccup, then you haven't lost anything, while you have a cutoff on your upside by selling the call, the higher up call. But other than that, nothing that we see here coming up. And I would say that the two term structures in line confirm that most market players see it the same way.
All right, that music means we've come to the end of another sojourn through the world of European derivatives. Man, an hour flies when we're having fun here on the show. But before we go, let's go around the horn, check in with everyone, see what they have cooking that may interest our listeners. Rich, we'll start with you, sir. I know you work on a variety of newsletters and columns. If folks want to check all that out, where should they go? What should they do, sir?
So I mean, the easiest thing to do is either go to my to follow me on LinkedIn, because whatever I'm working on, I'm going to be sharing it on LinkedIn, and then you can go and subscribe and then get signed up for that at that particular place where I'm working on it. So I think just follow me on LinkedIn, and you'll see everything that I'm working on, all the different content, all the written and podcast content that's out there. You'll be overwhelmed, and you'll be probably bored of it pretty soon.
Especially if you love all things FX. Rich will go deep into all that fun. If you want to know how to spell his name, listeners, it's EXCE, 2 L's there. So forget those Excels with 1 L. Rich Excel with 2 L's on LinkedIn. That'll get you to all of his columns, including writing about some VSTOXX out there as well. So a lot of cool stuff in the offing. You like ag options. I know Rich talks about it. All kinds of fun out there, and including I tease him, but some dabblings in the world of FX as well. Mr. Rhoads, same question for you, sir. Where should folks go if they want to hear your musings, in particular on all things, let's say, VIX and VSTOXX and Vol, sir?
Just follow me on Twitter or X. It's just my full name, Russell Rhoads. Anything I do, I always just post links to it up there. So that's easily the best place to follow me.
There you go. And last but not least, Sascha, if folks are intrigued, they want to check out what you and the team are cooking up over there in Eurex, maybe on the vol side or just on the straight futures side. Where should they go? What should they do, sir?
Well, first of all, start with Eurex.com, and there you can see either new product launches, product initiatives. We have market news updates, news flashes, and everything right there, including our volatility special, our European equity index news. We have fixed income news. So we have all sorts of newsletters that you can either check out for once. You can subscribe for a sign up, and you get them every month, every other week, depending when they come out. So there's lots of stuff to discover on the Eurex.com website.
There you go. If you're checking out all things European derivatives, your starting point should be Eurex.com, EUREX.com, the place to go to kick the tires and light the fires. That's going to do it for us on episode 7 of the European Market Brief. Not done on the network today, not by a long shot, though, listeners. I'll be back in about an hour and a half with our buddy, the Oracle from New Hampshire, as well as some special guests to talk all things advisors and options. Should be a fun time. We get into vol a wee bit on that show as well. And to wrap things up, we'll be back one final time today with the newest addition to the network, the Hot Options Report. Then, of course, we're back throughout the rest of the week with our usual array of content until we're back with episode 8. Hard to believe, episode 8 already, coming up on the horizon of the European Market Brief. We'll see you then, and, of course, stay safe out there, everybody.
The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Eurostocks, VSTOXX, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.